At what point does this begin to catch up, and does this begin to drag on the economy?
Well, thank you. First of all, thank you for having me on, and Happy New Year. So I think you can argue that it may start showing up in the near future. And by that, I'd say if you look to last year, as you know, the whole story was about strong personal income, a lot of government transfers to households. So income really held up in both nominal and real terms. And as you point out, that may be shifting. And if you inflation adjust disposable income growth, and in real terms right now, real disposable income growth has been turning negative the past few months. Now, I don't think any of us really think that will continue, but for the moment, you could argue that it could have a dampening effect on spending as we move into, say, the early part of 2022. I think where most of us expect inflation to come back down, but we also expect labor market conditions to remain tight. So we think the mix will still be for solid wage growth and some reversal in inflation over the first half of this year. But I think you make a good point that right now it's likely to be a bit of a modest drag on household spending.
It's interesting. We saw the 10-year Treasury yields test that 1.8% mark to start the week. Now it's come off from there. In the near term, can we say that rates have potentially peaked here? I mean, why are we seeing a buy-in back into bonds right now in the midst of data like this?
Yeah, I think what you saw coming out of the end of the year, the first week of this year, we had a very large repricing in bond markets. What I would say is bond markets seem to be pricing in, 3 hikes out of the Fed this year and balance sheet runoff to begin this year. And so I think it's that repricing that pushed the 10-year higher. We do think the 10-year yield will be moving higher over the course of 2022, pushing, say, towards 2%. As these rate hikes become, actualized, we think the Fed will start lifting rates in March. We think the balance sheet runoff will begin in July. So there's room for these yields to go higher. But what you saw at the first part of this year, that big move higher in the long end of the curve was markets taking on board. Not only are we going to get rate hikes out of the Fed, but we're also going to get balance sheet runoff. So we think things are, fairly priced where they are at present.
Hey, Michael, I wonder how key you think vehicle prices will be. There's some forecasts out there that they could be falling outright by the middle of the year. But, could that be offset by something else, wages or shelter or something related to more entrenched concerns? I mean, how important is that, vehicle prices?
I think it's crucial. I think it's crucial to most of our forecasts that inflation will be coming down over the course of the year. So a lot of the increase, that's 7%. Yes, there's a gasoline component to that. Gasoline prices up roughly 50% year on year. Food inflation has been coming in fairly solidly. We got another 0.5% increase on this month. But the majority, when you kind of look past food and energy, the majority of the rise in the remainder of inflation has come from new and used cars, household appliances, big durable ticket items. We suspect, and I think others expect the same, that as some of these supply chain disruptions go away and the chip shortages get alleviated and new vehicle production rebounds, used car prices are a key candidate for a big reversal this year. And I think we're factoring that into our inflation forecast. So I think it's very key that as the economy, continues to recover and learns to live with the virus over time, it's not a straight line process, but the trajectory is one where each subsequent wave in prices is something the economy can work through a little better.
Okay.
And so as that happens, you should get a reversal in some of these durables prices that have seen, large run-ups, and used cars are the prime candidate.